please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Thanks, Robert. Next question, please.
Next question is from the line of Michael Lasser with UBS.
Good morning. Thanks a lot for taking my question. Can you offer some perspective on your philosophy about absorbing operating losses from this business kind of beyond the next 2 years, and how you think about the governance structure and its influence on the business between generating growth and building for the future and managing more intermediate-term profitability?
Yeah, Michael, this is Brett. I'll take the question. As you can imagine, what you just described is a lot of things that we've been discussing as a management team, and we've said that before, that these are the kind of things that we've been discussing. And as we went through this process, we're certainly thinking about how to set this business up 10, 20, 30 years from now to be incredibly successful, but also understanding short-term expectations from shareholders, and we have expectations of ourselves as well. And so it's really that balance. And that was a big part of these discussions. We realized from an investor standpoint in the short to midterm that the dilution is not insignificant. But when we balance that out with an opportunity to really be a player with an innovative company with 1.3 billion people, we felt like this was the right investment at the right time for Walmart.
Thanks, Michael. Robert, next question, please.
The next question is from the line of Christopher Horvers with JP Morgan.
Thanks. Good morning, guys. So I had a more of a big picture question. As you think about deploying $16 billion in capital, how did you weigh that versus deploying that in the U.S.? Does it limit your ability to do more in the U.S.? We saw yesterday that the Uber delivery relationship was ended, according to the press reports. Why not use that capital in the U.S. to shore up same day delivery, or do you think you think the U.S. platform is where it needs to be from a last mile perspective? You generate $20 billion in free cash a year, so this would seem to limit another sizable capital deployment in the near term.
Yeah, Chris, this is Doug. I would say that the plans that we have in place reflect ongoing investment in the United States, and it's not our intention to let the business suffer as a result of investments made elsewhere. But we are being choiceful about resources. I think the announcement in the UK is representative of that. So we've gone through and basically continually go through a process of prioritization to make sure that our investments are balanced relative to where we see opportunity, both sales and profit-wise, over the mid to long term.
Robert, next question, please.
The next question comes from the line of Robbie Ohmes with Bank of America Merrill Lynch.
Oh, hey, guys. Another kind of big picture question for you, Doug. Maybe a little more background, a little more on, why do this right now? And also, I think Amazon has shown much stronger market share gains the last couple of years, more recently in India, and Flipkart's market share gains have been slowing. Does Walmart have a strategy to help, Flipkart re-accelerate, market share gains in India? And, just another question would be, does Flipkart bring anything to Walmart's U.S. business or other international businesses?
Yeah, Robbie, we like Flipkart's plan and the results that we've seen in the business over the last couple of quarters in particular. And I think it should be emphasized that this is more than just a marketplace business in e-commerce. Again, the logistics capability, the payment capability makes this one unique. And so we feel like that we're going to be able to learn about how pieces of an ecosystem work individually and collectively, and take that learning to other parts of the world. And there is a strong tech team here. And I've really enjoyed the interaction we've had over the last few months, including being here this week and getting to meet them and hear about some of the innovative things that they're doing across the business in the apparel area as well as in payment and in e-commerce. So I do believe that we're going to get learning out of Flipkart that'll help the rest of the business. It may also be worth mentioning that for a long time now, we've had tech resources in India. We have a sourcing operation here, so we're really familiar with the country in addition to the cash and carry business that we operate. And we have seen some great talent And I expect that we'll see people come out of India to help lead parts of our business as well as tech innovation.
Thanks, Robbie. Robert, next question, please.
Next question comes from the line of Scott Mushkin with Wolfe Research.
Hey guys, thanks for taking my question. I had a question and a clarification. In the press release, it talked about, I guess, get to the point. Are you guys going to maintain your credit ratings when you do this, or are they going to fall? And then I actually have a question, so a clarification and a question.
Yeah, Scott, this is Brett. As you would imagine, we've discussed this with our rating agencies, and I'm sure they'll be issuing reports at some point. But as we've said, our strong credit rating is important, and we believe with this, because of what we've done over the last couple of years, from a working capital perspective, we started bending the cost curve in the business. We've set ourselves up financially really nicely to do this transaction and believe our credit profile will remain very strong.
Okay, and then my question, and we kind of hit on it a little bit, but I mean, obviously, you guys have done a remarkable job with the U.S. business. At least it's obvious to us. But also, I think if we take a step back, the investments made overseas have generally been a little bit more difficult, and we'll also see the e-commerce has been losing money for long, and we keep waiting for that turn, but it really hasn't happened yet. So I guess, we look at the numbers, $28 billion in EBIT in fiscal 14. Looks like it's going to be somewhere like $21 billion in fiscal 20. I guess I'm just trying to understand, why not deploy capital into your core business in the U.S. or North America, because obviously Canada and Mexico do really well too. I'm just trying to understand the philosophy a little bit better, because the track record and the core competitive advantages you guys have are really in these super centers in North America or stores in North America. So maybe some comments on that. That'd be great.
I'll go first, and you guys can chime in if you want to. I think if you look at the international business, it's important to remember it's not one business really, and evaluate Walmex in Canada, Brazil independently as you do that. As it relates to the U.S., it's obviously very important that we win there. And if we were looking at this company with, say, a 3 to 5 year horizon, we would invest in the U.S. And protect the core and maybe consider not doing other things. As I mentioned a few minutes ago, we've got a plan that relates to the U.S. investment, and we're comfortable that we can execute that plan and have a bit of a longer-term point of view beyond 3 to 5 years as it relates to setting the company up for growth and profits in the future. And when you step back and look at the world, look at all of the countries, their size, their growth rate, their potential, there just aren't opportunities like the one that we're looking at. India as a country, the growth rate in GDP, the size of the market, the growth of middle income, the opportunity that still exists for the adoption of technology and mobile, and then click down to what space would you want to be in. We're retailers, and if you're going to look at the retail space in India, the e-commerce marketplace is the place you'd want to be, and the fact that it's got this fashion business, payment business, logistics business is just an added plus. So if you're thinking 10 years or beyond, you check the box on the country, you check the box on the positioning of the businesses, and you check the box on the management team beyond just one person but a group of people. I think it leads you to a conclusion that this is the right decision to make and to do this now. And we're excited about it. And I think you can continue to expect us to have success in the U.S. at the same time.
Yeah, Doug, I'd just add to that, which is we continue to be thoughtful about the choices we make around the portfolio, and the Asda Sainsbury's decision that we announced last week is a really good example of that, about how we're finding unique solutions around the world to make sure that the capital choices that we make are the right ones overall.
Thanks, Scott. Robert, next question, please.
Next question is from the line of Simeon Gutman with Morgan Stanley.
Thanks. Good morning. Just a couple of questions. I'll put it into one. First, I think there was an earlier question on infrastructure. Curious if having stores one day and Walmart being able to open stores one day is any part of the consideration. And the second question is, as you've evaluated this decision with the board and amongst yourselves, I wanted to ask about the hesitations you may have had from an operating perspective, not about the losses, which you said was a tough decision, but just, what are the considerations why this business may or may not scale, if the market doesn't scale, if it's a competitive set. Just curious what some of those issues may have been.
Maybe I'll take the last part first. I think we are excited about this management team. And when I think about risks, the first one that comes to mind is we've got to balance the requirement that we will have as it relates to compliance, ethics, accounting standards and controls, all the things that as a company, we've been doing for a long time in lots of markets, and understand that this is a business that's still relatively young and has been focused on customers, and inevitably there are going to be some improvements that we want to make there, I'm sure, as we get into the business. Doing that at the same time that you enable the freedom to move with speed, innovate, serve customers is this tricky balance. And I've been so encouraged by and impressed by what I've learned from this Flipkart team over the last few months as it relates to problem solving. They identify customer problems, other challenges in the business, and they innovate and they do it quickly. So part of what we're doing is investing in a country and a position, certainly a management team, leadership team, but we're also investing in a set of creative problem solvers. So it's not just what they've done before, but what they will do that causes us to be so optimistic about the opportunity.
Thanks, Simeon. Robert, next question, please.
Next question is from Ben Venue with Stephens.
Hey guys, thanks. This is actually Daniel Imbro on for Ben. Thanks for taking our questions. First a clarifier, then a question. To clarify, you noted the dilution of the transactional increase in FY20. Is that just annualizing the FY19 impact, or are there more significant incremental investments that you guys will need to make to support this growth?
Hey, Dana, this is Brett Biggs. For the most part, it's the annualization of it. So what you see in FY19, again, we don't know when the transaction will close, but if it were for a half year, that's a half year number. But we do anticipate allowing this company to continue to accelerate its growth, and we'll be supportive of that.
Thanks, Daniel. Robert, next question, please.
Next question comes from the line of Scott Ciccarelli with RBC.
Good morning, guys. In today's press release, you commented that over the long term, you expect losses to decline, which frankly isn't the same as transitioning to profit. So I guess the question is there a general rule we should be using for either how big you think this business needs to be to hit break even, or maybe how far into the future till the business hits break even?
Yeah, this is Brett. I appreciate the question. As we've been in India for a while, we know the market well. We want to make sure that we allow this business to do everything that it needs to do to grow. The good thing about our business is we're global. There's a lot of different levers that we have to pull and how we balance this out as a company. But we want to allow this, as in other parts of our business, to do what it needs to grow as we go through time. And as we go through time as a company, we'll be coming back and talking to you about what our expectations are. And right now, going out to next year is what we feel comfortable talking about at this time.
Thanks, Scott. Robert, next question, please.
Next question is from the line of Ed Yruma with KeyBank.
Hey, good morning, guys. Just two quick ones. First, on the $2 billion that's part of the recap here, is that to accelerate growth, or is that to kind of offset maybe cash losses in the business? And then secondly, how important is a physical retail strategy for the market going forward? Thanks.
Yeah, on the $2 billion, again, we want to give them every opportunity to do what they want to do to grow the business, and so it really is to allow them to continue to accelerate what they're doing.
As it relates to, sorry, Judith, go ahead.
No, sorry, Doug. I was just going to say, from a retail strategy perspective, clearly we already have an Indian business there with 21 cash and carry stores. They've returned to growth recently, opening 5 stores this year. They'll continue to run as an independent part of the business, but we definitely see in the future down the line that we can use omni-channel experience. to see how that we can continue to grow and find innovative ways to serve customers.
Robert, next question, please.
The next question is from the line of Bob Drbul with Guggenheim Securities.
Hi, guys. Good morning. Just have two questions. The first one is, when you look at the e-commerce penetration, as a percentage of total retail in India, the last couple of years, 1.8, this year 2.1, projected to go to 6% over the next 5 years. Why are you convinced that that's going to triple in terms of penetration over the next 5 years? Like, what's going to change between, now and what's happened in the next 5 years in terms of that penetration rate? And the second question that I have is, can you just talk to the competitiveness for talent in that market and your ability to retain the talent within the Flipkart organization?
Yeah, so I'll just talk about the the growth there and what that looks like. What you've also got to remember is the absolute numbers in India in terms of the total population is really significant. So those percentages are a lot of customers on the platforms that we're talking about. But in terms of the growth, the information is that we've got a CAGR in retail of about 9% over the last 10 years. E-commerce is forecast to grow at 4 times that rate. You've got a population that is becoming increasingly mobile, where you've got internet penetration across the country increasing as well. It's going to be at around about 60% by 2020. It's about 30% today. So all of the indicators are there that this will be a market that will accelerate very fast from an e-commerce perspective. Interestingly as well, if you look around the world, if you take a market like China, and you think about that 6 years ago in China, that was a cash-on-delivery market. I don't think anybody would have predicted then as to what it looks like today to be one of the most sophisticated payments markets in the world. So we're really excited about what that level of growth looks like and what that will give us. From a team perspective, in terms of retention, it is clearly a competitive market in India, but Flipkart's already proved itself that it's got a great tech team, and Doug's just talked about that and some of the talent that's there. We're excited not only about Binny Bansal, who is going to continue to lead as Group CEO, but the business unit leaders as well. And they have a real depth of talent across the business. As you'd expect, we're putting the appropriate retention into place to make sure that people know how excited we are about them continuing in the new business.
I think there's also an exciting dimension as it relates to the IPO that we've spoken about in the future. And I think the other thing that's key is giving them freedom to continue to innovate and lead. If we overmanage this thing, that'd be the best way to chase off talent, and we're going to be careful not to do that.
Thanks, Bob. Robert, next question, please.
The next question is from the line of Edward Kelly with Wells Fargo.
Hi, good morning, guys. Just two questions for you. First, can you take a step back maybe and help us think about the cash flow profile of Walmart right now? If you made significant investments in the business, in the U.S. business since 2014, but your free cash flow hasn't skipped a beat. If anything, it got better. Now you're selling Asda, which is generating cash, buying Flipkart, it's dilutive. And I don't want to sound short-sighted because I know you're not going to run your business like that. But how should we think about the free cash flow profile over the next few years, and are there offsets? And then the second question I have for you, is there any change in how you're thinking about investment in the U.S. business? So your appetite for near-term losses for the longer-term benefit from the outside looking in seems to be growing. Does the U.S. business also need more investment? Thank you.
Yeah, you bet. This is Brett. I'll start off. From a cash flow perspective, and you pointed out our cash flow has actually gotten better. So if you look at the last 2 years and combine the last 2 years, we've generated almost $60 billion of operating cash flow. CapEx has actually come down a little bit as we're building fewer stores. We're investing our CapEx differently, but it's come down actually a little bit significantly over the last 3 or 4 years. So as we go forward, we're going to balance. Again, we've got a lot of different things that we can do, a lot of different ways for us to balance what we want to do long term with short term and midterm expectations. And that, as a management team, that's what we spend a lot of time on, is making those decisions. From an investor standpoint, what I believe you should be encouraged by is that we are making decisions. There are times today where we're going to make a big investment. There's times where we're saying we're going to invest differently or we're going to get out of a situation. I think you've seen us do both of those. And so we're trying to take a balanced approach as we go into the future. Doug, I don't know if you want to talk about the U.S. business. Your thoughts there?
Yeah, sure. I think the U.S. plan continues to include some level of price investments, which we manage very closely. You know that we made some additional changes to wages that we shared a few months ago. We'll continue to see that through. No new news as it relates to that. And then as it relates to U.S. e-commerce, if you look back over the last few years, we've been telling you, hey, we've got to get our fulfillment centers open, which we've done. We've got to get our e-commerce tech platform in place, which we've done. Continues to be enhanced, but it's there.
Well, that's the global leadership team of Walmart addressing analysts and investors in the U.S., explaining to them the rationale behind the $16 billion investment in India. Analysts, they're asking them the question, why India? Could this $16 billion have been used in the U.S.? Could it have been used or put to better use in the North American markets, for instance? And the Walmart global team explaining why they're betting on India, why they believe that the e-commerce story in India is going to grow exponentially, giving the example of China and how that is today a sophisticated payments market and how they see India heading in exactly that direction. It is a done deal. For the benefit of our viewers who may just be tuning in, just as CNBC TV18 has been reporting, Walmart and Flipkart have today signed a definitive agreement. Walmart will buy 77% stake in Flipkart for $16 billion. This deal values Flipkart at just over $20 billion. Now, Walmart will fund this deal through fresh debt and cash on hand. It will also infuse equity worth $2 billion in Flipkart post the acquisition. So what is important to note is that this $2 billion is going to be funded to aid growth and acceleration as part of the Flipkart expansion plan. So who stays and who is leaving? Co-founder Binny Bansal is staying on. Sachin Bansal will exit the company. That is now confirmed. Tencent and Tiger Global are staying, and they will also retain their board seats. Microsoft will also stay invested. SoftBank is cashing out along with Naspers. Naspers, in fact, has also put out a release saying that they will exit the company altogether. Sachin Bansal exits the building. Walmart is in talks with potential investors, and if things materialize, Walmart could reduce its stake in Flipkart, but it will continue to hold majority. Here is what is left. The Flipkart board composition is yet to be finalized, and Walmart expects to close this deal by the end of the year. That's the sum and substance of this mega deal. Still with us, Sajid Veer Gogia, Chief Analyst, Founder and CEO at Greyhound Research, and Shanti Mohan, Founder at Let's Venture, and Harminder Shani, Founder and Managing Director of Wazir Advisors. Sanjit, let's talk about where we see this headed now. You know, a lot of questions on the investor call about why are you putting this money into India? Could it not have been used in the home market of the US and so on and so forth? I also want to pick up on the point there being made by the global leadership team of Walmart on giving the space to the current Flipkart leadership team to continue to operate as is. The words used were, we don't want to overmanage. And that's going to be important because culturally, they're very, very different organizations. This is a very different market from the US. And hence, the potential for overmanaging and hence underperforming is large. We've seen that happen with Walmart in Brazil. I'm hoping that lessons learned from there will not be replicated here.
It's a great point, Shireen. Yes, Brazil was very a bad case for Walmart. Having said that, though, there is enough and more evidence that Walmart is beginning to change. If you look at the Japanese market or if you look at the UK market as well, the company is investing into companies where it wants to partner and not really overtake their business. So similarly with India market as well, we really expect that the Flipkart management will be able to play in solo and, of course, in tandem with the India management as well. Having said that, though, look, the two companies come from different paradigms altogether. Flipkart is this very fluid startup culture, which is based on innovation and technology. Whereas if you look at Walmart, it is a traditional, bureaucratic, rigid company.
Yes.
And, my worry still remains.
Okay, let's talk about what could be the possible road ahead in terms of this mix of offline and online, this model that we're talking about. What is the closest to that we have in India? Is Tata Click possibly a model that could be replicated? Or is that at least close to what these two could aspire to move towards? Yeah, Sanchit. You can just put it on.
Okay.
Not a problem.
Okay, I think the Tata Click is a very, very important point, and it wasn't raised in the debate at all. I think Tata Click and Paytm in some ways has been trying to achieve the entire phygital, if you may, but it's not been really an easy journey. But I think the Walmart-Flipkart is a hope for me because it's the first company that has actually come out and spoken about supporting the Kirana stores. In many ways, it's a partnership waiting to happen because, ultimately Kirana stores do form the backbone of the Indian retail segment. And if you go and speak to the distributors, the processing industries, they're in dire straits. They're the ones who want to leave their business. So if there is a company that's right here wanting to invest in these businesses, these micro businesses, and aid them to transform them and modernize them, I think there is a hope for the country, and this is India's moment in many which ways.
Well, it is India's moment in many ways indeed. Shanti, you were listening into the questions that were being asked of the global leadership team of Walmart on why this investment, why the decision to back Flipkart. When do they see this making money? When do they see an IPO? And of course, all of this, the finer details, the granularities are yet to be worked out in terms of timelines. But what struck you there, and I was just discussing this here with Sanchit, that, while we talk about the potential of the Indian e-commerce market, the retail market, if you listen into the comments there, most people or most analysts there were almost puzzled by Walmart's decision to put in this kind of money into India.
I'm not able to hear you, Shireen. The line is not clear.
Okay, let me check if Harminder heard me. Harminder, I don't know if you heard my question, but I don't know if you found that interesting as well, for the lack of a better word, that analyst after analyst, they're asking them about why they chose to invest this money into India as opposed to the US or North America or any other market. Here we're talking about the great India story, the aspirational Indian, the market opportunity here, but it took time for the Walmart leadership to convince global analysts who track the company about the potential that India holds. Okay, well, we seem to be running out of luck there with audio lines, but we'll take a break then and wrap up what has been a marathon for us here on CNBC TV18 as we decode and analyze the details of this transaction. Sanchit, you wanted to make a very quick point on that? Yeah.
One for my US-based analyst friends out there. Let me put this entire opportunity in perspective. India is going to be a $1 trillion retail opportunity in the next 2 years. Next 2 years, not the next 5 to 10 years. This partnership can potentially modernize more than 10 million mom and pop stores and enable, via digital payments, 100 billion transactions. So that's just putting in perspective.
Okay, Shanti, now if you can hear me, I was asking you, there was a degree of skepticism there on the decision of the Walmart leadership team to invest $16 billion in India. I don't know if you caught that as you were listening into the investor call. So it is a done deal. As we've been reporting, Walmart has acquired majority stake in Flipkart. We're discussing the details of the deal and the complexities going forward with Sanchit Virgogia, Chief Analyst, Founder and CEO at Greyhound Research, Shanti Mohan, Founder at Let's Venture, and Girish Banwari, Founder, Transaction Square. Girish, let me come to you now because one of the potential challenges is going to be the tax liability. And we don't have details yet on how that's going to play out, but SoftBank has decided to exit. Naspers has decided to exit completely. What do you make of what could potentially be the challenges on the tax front?
Clearly, now you look at the profile of the people who are selling. There are Indians selling and there are non-resident selling. Now, the Indian sellers will have to pay tax, capital gains tax in India at the rate of 20% on the gains which they make, plus surcharge. And the foreigners would have to pay tax depending upon whether they are owning the shares of the Singapore company through a treaty jurisdiction or not a treaty jurisdiction. For the foreigners, the issue is a little more complicated because there's a withholding obligation on the acquirer, which is Walmart. And it'll be interesting to see what position is taken on the withholding front as to whether treaty exemption is available, not available, and 20% versus 10% rate, and how will this whole thing pan out? Because this is clearly an indirect transfer. And indirect transfer taxability depends upon treaty jurisdiction. And obviously, there's an overhang of a Sanofi case, which says whether the treaty concessions can be available to indirect transfers. Subject to that case, still there is some planning which can be done through a treaty jurisdiction, if it is possible. Another interesting tax point here is the carry forward of losses, because the Indian company has losses, I understand. And after the beneficial change in ownership, whether the losses will be carried forward or not. So it will be interesting to see how this deal is structured, whether enablement is done for the carry forward of losses or not. That can be a significant value in terms of the future potential of tax savings.
Okay,
So
that's an interesting point that you make, Girish. Sanchit, let me just bring in a quick word from Sanchit Goge, and then I'll come back to you, Girish, on the issues raised there by Girish on the tax front, and also, as he was interestingly pointing out, this business of the carry forward of losses now that the ownership changes as well.
Yeah, it's a very interesting one. Look, I think let's look at this in the light of the fact that the current marketplace is dominated by internal sellers, and 3 of them, and that's going to add a huge layer of tax challenge for them. In addition, I think the fact that when they do invest in the logistics and supply chain as well, how are those companies structured will also have a huge impact on how the tax liabilities of the combined entity. So I think we don't, as Girish rightly said, we still don't have clarity. But the fact that the current marketplace is dominated by the 3 in-house sellers, and how the logistics and supply chain companies are structured will define the tax liabilities ultimately.
That's right. So when you talk about the 3 sellers, you're talking about Flipkart's 3 sellers, and that's Flipkart Smart Buy, DigiFlip, and WS Retail. So that's the structural complexity that Sanchit is talking about. But Girish, what is it that you would watch out for now in terms of details on this particular transaction?
The details would be interesting to see as to whether the sellers, especially the non-resident sellers, are they from a treaty country or not from a treaty country? Because the tax collections here could be huge. The Indians will certainly have to pay taxes, but what tax collections will come from international sellers would depend upon the treaty exemption or not. And to couple with that, it's an indirect transfer. So there's a withholding obligation too. So it's going to be interesting to see what is the tax position being taken by the non-residents. Very, very interesting.
Yes, that certainly will be an interesting aspect. It will be, and we don't have the details on that just yet. But Girish, let me ask you, what do you make of the deal itself? I'm just taking a look at some of the numbers now. If you take a look at the valuation of Flipkart at a little over $20 billion, that works out to roughly about 1.35 lakh crores. If Flipkart was listed at these valuations, it would have been the 19th largest company by market capitalization in India. In fact, Flipkart is equal to DMart, which is listed, plus Future Retail, which is listed, plus Trent, plus Shoppers Stop put together. So that's the kind of value that's been created by these 2 young entrepreneurs, 1.35 lakh crores. That is the valuation of Flipkart. Girish, a quick word from you on this transaction itself and that headline number.
I would think this cannot be compared with the ordinary listing, because in this there is a huge strategic India premium. And this India premium is 1.3 billion Indian people who are actually users of this, and which is the potential for the next few years to come. So if you had to list this, I don't think you would have the same kind of valuation, because there's a huge strategic premium, there's a huge control premium which is being paid here. And clearly this demonstrates the potential of the Indian market for the years to come. If you just compare the other comparable listed, which is DMart, as you said, or other comparables in the Indian marketplace, I'm not sure the Indian market is very mature enough to come with this kind of a valuation over a longer period of time. So please don't compare the strategic premium with the ordinary valuations with the Indian market gives. But
all
clearly,
right,
this just
we
shows
won't compare the strategic premium. Yes.
But this surely shows the potential of the country here.
Go ahead.
Clearly. This really demonstrates the potential of the Indian consumer, which is the strategic premium for the years to come.
This yes. Absolutely. And so let me end then by asking you, Sanchit, there is consensus on one thing, that this truly is a win-win as far as India is concerned. And this truly is a zing moment, as one of our panelists said, for India's startup ecosystem and, of course, for the Indian retail market. But outside of that, while we can argue about what it will eventually mean in terms of this agri-supply chain and reaching out to farmers and benefiting farmers and so on and so forth, what is the one thing, the single biggest difference you believe this transaction will make?
I think it's the belief in the India opportunity at large, which I think really differentiates that. And let me tell you why I say that. Because, companies have opened up, for example, abof.com. And it's not about opening a platform. It's really about believing and delivering what really Indians need. So despite the fact that, Aditya Birla had an India opportunity and couldn't make much of it, but compare that to a Flipkart, and they've really made tons and tons of money for their investors. And now with Walmart acquisition, I truly believe the fact is that when a company as large as Walmart comes in, not for a minority stake, but for a majority stake, it's truly a sign that they believe in the India opportunity. And I think that's what we should be taking home tonight.
All right, gentlemen, we will leave it there. This has been a marathon coverage here on CNBC TV18. Our story has been confirmed. It is official. It's a big moment. Walmart picks up Flipkart in a $16 billion deal. Binny Bansal stays on. Bittersweet moment for Sachin Bansal as he exits the company that he co-founded. Do stay tuned to CNBC TV18. We're not done yet. We've got all the information, the opinion. We've decoded the deal and put it simply together for you on CNBCTV18.com. So if you missed out on watching our show, visit CNBCTV18.com to catch up on all the insight. Back in a moment with more.